Hi, it's Neil here. Welcome back. Chapter 12, International Transfer Pricing. We're really going to get into some of the good stuff here to understand the strategies of multinationals with respect to transfer pricing, but we're also going to investigate the broader environment because there are many stakeholders involved, not to mention the various regulatory authorities around the world. So let's have a look at some of the chapter topics that we can cover. In part 1, we want to look at basic transfer pricing strategies of the multinational. And then in part 2, we'll actually expand that to consider some of the other factors. So, for example, the environment, the competitive environment, and the regulatory authorities. And of course, part 3, which we'll try and cover in another video, where we'll actually look at government reactions. And it's very important that we sort of break up these topics because there's a lot to get through. The learning objectives in this part is going to be going 1, 2, 3, and we're not going to cover 4, 5, and the other learning objectives. We'll cover them in another video, but for now we're looking at 1, 2, and 3. That is, we want to describe the importance of transfer pricing in achieving goal congruence. We want to explain how the objectives of performance evaluation and cost minimization can conflict with determining international transfer prices, and we want to show how discretionary transfer pricing can be used to achieve specific cost minimization objectives. So that's our focus here. We just want to really focus on those 3 learning objectives. Of course, in another video, we're going to look at the government's reaction, various transfer pricing methods associated with the sales of tangible property, and we're going to look at advanced pricing agreements and describe worldwide efforts to enforce transfer pricing regulations. Yes, we know those efforts are continuing. All right, but let's have a look at part 1, transfer pricing strategies, shall we? Look, let's start off with the basics. Let's start really basic here. A sound transfer pricing system should accomplish the following objectives. Look, we want to motivate divisional managers to make sound decisions and to communicate information that provides a reliable basis for decisions. We want to have a report of divisional profits that's a reasonable measure of the managerial performance of that division. And we want to ensure some divisional autonomy is not undermined. So these are somewhat nice objectives to have, but often they are conflicting objectives, and you'll see in a moment. All right, so what do we mean by transfer pricing? It's a determination of a price for the exchange of goods or services between related parties. And I think this is the key part, between related parties. So therefore, often transfer prices are not market-based. Often they are discretionary. They are negotiated or they are dictated by a powerful part of the organization, for example, central administration. Transfer prices are also referred to as intercompany transactions, and that can be in form of upstream transfers that go from a subsidiary to a parent, while downstream transfers are from the parent to the subsidiary. Transfers also occur between different subsidiaries of the same parent, sort of like a horizontal transfer. Okay, significant portion of international transactions are intercompany transfers. That represented 42% of US total goods traded. That means independent company transfers only made up 58% of US total goods trade. So transfer pricing is not to be sneezed at. Transfer pricing is a very important part of the economy. It affects the multinational strategy. It also has garnered the attention of regulatory authorities around the world. Okay, so what is the basic starting point of transfer pricing? The basic goal, where are we going to start here? Well, decentralized companies are organized by division. Divisional managers generally have significant authority, and so the whole approach to decentralization is that we're trying to get over this information overload where head office makes all the decisions. We're trying to delegate those decisions to divisional managers. In that case, they tend to have autonomy to make decisions as they wish, but somehow we want to try and control those decisions. And so because they may have a different incentive than what head office has in terms of what is good for the overall company and the shareholders, there is an agency problem. Since Divisional managers make decisions in their self-interest, and managers' self-interest can vary with the best interests of the company. And so that is a big major key for why multinationals will decentralize authority to various subsidiary managers. So often we have an accounting system that helps to alleviate this agency problem by providing incentives to divisional managers so as though they'll behave on behalf of the company. They'll do the things that are profitable for them, but those actions are also profitable for the company because they get a bonus for taking those actions. Okay, when the company makes profits, yes. So we're trying to get goal congruence, that is those divisional managers to do the right thing by the company as a whole. See, these concepts are relevant to both multinational and purely domestic companies. All right, now here's where transfer prices come into being. Because intercompany transfers, either between subsidiaries or between subsidiaries and head office, involve a transfer price, then that's going to figure into the performance evaluation reward system that is given to these divisional managers. And we want them to act on behalf of the company. And so therefore that's going to figure into how that transfer price is set. Because if you set it the wrong way, the manager is not going to be very, very happy, even though the transfer price is set to get money out of that company, out of that country into the head office country. But that may not be congruent with the best interests that the manager has to make more profits for that subsidiary. So originally we started with this goal congruence. We started with this need for goal congruence. So a subsidiary acts very well on behalf of the multinational. But once we start giving autonomy to the subsidiary and we start using the accounting system to help measure that autonomy and control that autonomy through the use of bonuses for profits and things like that, once we start using transfer pricing, where we're not using a market-based transfer price, we're using a discretionary transfer price in order to move money, in order to minimize tax, in order to achieve some objective, that objective may conflict with the original setup of the accounting performance evaluation system to keep the divisional manager's goals congruent with the overall multinational headquarters goal. So let's have a look at some of these points I've just made. Transfer prices do directly affect the profits of divisions involved in an intercompany transaction. Some are based on divisional profits. The effectiveness of these are influenced by the fairness of transfer prices. Now, of course, once you mention fairness, it really depends on who is judging to be fair. What is fair to the head office in actually getting cash out of a country may not be fair to a divisional manager who wants to show that they made more profits, so the divisional manager can get more bonus. The effectiveness of these affects the satisfaction of managers, as I just said. Yes, so suddenly we've got a conflict between the goal of a performance evaluation system and the potential goal or the other potential goals of a transfer pricing system. Of course, you can set the transfer prices to be congruent with the performance evaluation system, but it may go against other goals that the overall multinational strategy has prioritized. All right, cost minimization. Here's another goal that multinationals may have. And that's basically the opposite of profit maximization. That's an important objective. And so we can use transfer prices, manipulate them between countries in order to minimize the taxes, overall taxes paid by a multinational group. Yes. And so this is what we call discretionary transfer pricing. Remember, the ideal transfer price for performance evaluation of a subsidiary is a market transfer price. It's market-based, it's objective, it's not unfair, it just reflects the reality, and divisional managers are going to be happy with that. But once we start focusing on these other strategies of cost minimization, where we want to minimize our taxes, overall taxes, now we're going to have to start setting discretionary transfer prices. So The most common approach is to minimize costs by shifting profits to a low tax rate jurisdiction. Yes, that's the way to go. Now, suddenly we're moving away from this performance evaluation objective of the subsidiary manager. Can they be in conflict? Of course. Can they be in congruence? Sometimes. Let's have a look at some of the other factors we need to consider. All right, cost minimization example here. All right, we have Padre Incorporated. It's a US company. It has two subsidiaries, Hijo and Hija. One is located in Chile and the other one is located in the US. The tax rate is 17% in Chile and 35% in the US. Wow, that's an 18% tax difference. Hijo in Chile, paying 17%, transfers 100 units of COSA to Hija at a negotiated transfer price of $10 per unit. Notice that this was negotiated, okay? That's not a market rate. Could be, but it was negotiated. The cost per unit for Hijo is $5. So Hijo is making a 100% profit margin and is making $5 per unit. Hija sells units in the US at $15 per unit. Again, Hija is making $5 per unit, but only 33% margin. Padre intervenes to set the transfer price at $13 per unit. Now, there's two things. There's a negotiated transfer price here. That's between the two subsidiaries. But now we have a head office intervention that says, thou shall use this transfer price. Let's have a look at the differences in terms of the tax consequences, shall we? So the divisional profits under the negotiated transfer price, let's follow it through. Hijo sells 100 units at $10 each. There's our $1,000. It costs $5. There's $500. Gross profit $5. Income tax effect, which is the 17%, and the after-tax profit is $415. Hija pays $10 per unit, and so there's the cost of goods sold, and then sells for another $5 per unit, $15 times 100 units, and the next tax effect is 35% on the gross profit of $500 for a $325 profit. Padre receives a total of gross profit of $1,000, and so as part of the group, Padre has to pay of that $1,000, that is $260 after tax effect, all right, and leaving Padre with an after-tax profit of $740. So we have an after-tax effect of $85 paid by Hijo. We have $175 of tax paid by Hija, so total tax is paid is $260. Let's have a look at the other one. That is the discretionary transfer price. Under the discretionary transfer price, the final selling rate is $13 per unit, and we can check that. Yes, transfer price is $13 per unit. So we have $13 being profitable made in Hijo's Chile environment, and so Hijo is making much more profit here because the sales are at $13 times 100. Before it was only $10 times 100, and now we have income taxes of $136 being paid here. Hijo is only paying $70, so the total taxes paid is $206. So therefore, under the discretionary transfer price, the actual tax paid is higher or lower. We can double check that. It was $260 under the negotiated transfer price. Now it's $206. So therefore Padre saves $54 for that transaction in terms of taxes. So we understand why we may set transfer prices in a particular way to minimize our costs. So let's have a look at this example here. Corporate profits under the discretionary transfer price, that is the second scenario, is $54 greater relative to the negotiated price. This results in a shifting of $300 of pre-tax profits from US to Chile. The overall tax rate decreases from 26 to 20.6%. The performance evaluation objective is better served by the negotiated transfer price, but the overall group profits in terms of maximizing is better served by having a discretionary price. Yes, the cost minimization objective is better served by the discretionary price. So immediately we have a conflict, all right? So we have a performance evaluation objective conflicting with the cost minimization objective. So let's put that down as our first conflict of transfer pricing objectives. So I read this before, conflicting objectives with a solution. The previous example illustrates how cost minimization and performance evaluation can conflict. Dual pricing is one solution to this conflict. Under dual pricing, the official transfer price used for tax purposes is the discretionary transfer price, and a separate set of records is used for performance evaluation using a negotiated transfer price. So this will complicate things a little bit more, but again, once you have the accounting system in place, you can do this with a little administrative trouble. Other cost minimization objectives are withholding taxes on dividends, which can be effectively avoided by setting favorable transfer prices. So the objective may not be to move profits into a lower tax environment, but the other objective may be just to reduce the withholding taxes you have to pay on dividends. Because you have more profits, then somehow you're going to try and get that cash out of that low tax environment. And so one way of doing that may be setting the transfer price to actually move those profits out of the higher tax environment. The same can be done to avoid profit repatriation restrictions. This essentially changes the cash flows from dividends to intercompany revenues and expenses. Now let me make a point here, is that this is the exact situation that Apple finds itself in. It's got all this billions of dollars around the world with its subsidiaries, and it cannot move cash from those subsidiaries back home without paying a dividend. As soon as it pays a dividend, then it has to pay US income tax on those dividend dollars. And so is there some way you can change the transfer pricing in a discretionary way to actually move profits across? And it's a way of actually moving across intercompany revenues and expenses that may give you a greater leeway in how you manage those revenues and expenses on your own books. If they come across as dividends, they're going to be taxed immediately as a dividend. But at least with revenue and expenses coming across, you might be able to offset them against other outflows that are made by the head office. Other cost minimization objectives are the minimization of import tariffs. And this is something that came up the previous week with the taxation of different countries. Yes, China may have a 25% tax, but if you add on the VAT and other taxes, it could be up to double that amount if you are making in China and exporting out China, or making in China and selling into China. The amount of import duties, tariffs, value-added taxes, these are other non-income taxes that are imposed by various countries, can have an enormous weighting on how you set up the transfer pricing objectives. Another objective may be to increase cash flows out of a devaluing currency. Yes, so in other words, this is an RISK management strategy. You just got to get cash out of a devaluing currency, and that's pretty important when you're working with developing countries. For example, South America is having lots of troubles with that, different countries there, and also in different countries in Africa. Yes. One more cost minimization objectives is to enhance the competitive position of a foreign operation, and we'll talk about that in a minute. Especially if that foreign operation is actually applying for a loan, you want to show that it has a track record of profits, and so then you're able to get a loan in the local bank account by showing a better books and operations of that foreign owned entity. Okay, so we've basically set the scene for the initial strategy for setting up a transfer price, okay? But we're starting from decentralization. First of all, multinationals have to decentralize, okay? So let's put that down. Number one, they have to decentralize. It makes a ton of sense to decentralize. Why? Because information overload. Why? Because head office never know all the information or what's going on in the local environment of their various subsidiaries, okay? Number two, because of decentralization, you have to have some sort of control, okay? What do you mean by control? Well, maybe some sort of profit sharing. So you want the divisional managers that have this autonomy to make decisions that are in the best interests of the information that they have, the head office doesn't have. And so you would use some kind of profit sharing to actually reward the manager for making decisions that are aligned with the overall multinational operations activities. So number three, once we start using transfer pricing, that has the potential to conflict with the controls that you have set up to ensure the goal congruence of divisional managers. So transfer pricing, depending on the strategy, can conflict, or it may be congruent depending on the strategy you're using transfer pricing for. If the strategy is not conflicts with the performance valuation of the manager, then you might use dual prices, that is one transfer pricing for performance valuation, another transfer pricing for the other cost minimization objective. So that's the basic starting point we want to work with. Now we want to work with some frameworks to have a more in-depth understanding of all the factors that could impact on transfer pricing. The conditions that influence subsidiary transfer pricing. Okay, so we've mentioned that there are cost-based methods, and they're generally preferred when the following variables are important: when there are differences in income tax rates, when there's a minimization of import duties, when foreign exchange controls and risks exists, and when there are restrictions on profit repatriation, so you actually get those profits out through the normal course of trade, and when there's a risk of expropriation and nationalization, so you've got the risk of a foreign country taking over the bank balance sheet or other non-monetary assets, and so you just want to get profits out as soon as you earn them in that country. There are market-based methods, of course, and they're preferred when the following variables are important: the interests of local partners and a good relationship with the local government. And so this one is what we mean by it's focusing on the goal congruence objective. The interests of local partners, it's in their interest to use a market-based method, and it's consistent with the goal congruence of a divisional manager that is remote, and they're going to see that transfer price based on market prices as being fair, and it's likely to get them to behave that's incongruent with the head office operations. Okay, so cost-based methods are likely to deviate from the goal congruence of a remote divisional manager. Market-based methods are likely to be in line with the goal congruence of a remote-based manager. All right, there are other three main areas of influence that can be put into another framework, and that is organizational efficiency and strategy, regulatory environment, and competitive environment. And so basically 2 and 3 is basically your country, location factors, where you choose to locate the subsidiary, and this one predominantly is your human motivation factor. And so here we have our human motivation factor here. All right, so we've got our little human here, and we want to have total organizational efficiency. We want the humans to do the right thing by the multinational, the headquarters. You know that, all right? Yes, but here is a country factor, and here also is a country factor. And so now we're pulling apart the two country factors to say that, well, okay, we don't just locate in a country because of the tax environment or because of the host government. We also may choose to locate in a country because of the competitive environment or the infrastructure environment. As I said earlier, there's an ecosystem, there is a logistics support infrastructure that supports a particular location. So these two here are really factoring in on the subsidiary location decisions. This is your person decision, okay? So I've pulled apart that location decision again and put it into regulatory and competitive environment. So what I'm making clear here is the regulatory environment is on this box and the competitive environment is in this box here. These three factors increase the complexity of transfer pricing. Okay, remember we started off with the person factors. Okay, the strategic role of the subsidiary, institutional influences, and environmental influences. Remember this first one, very invariably is going to be the person and possibly the value chain. Okay, so we can draw a little value chain here. This is great, I like that. We've got to have pictures to go with these things. All right, of course, environment can impact on that value chain a little bit too. There's a lot of things going on here, but just keep in mind, but what we're pulling out here is the institutional influences, yes. The organizational efficiency. There are several roles that transfer pricing can play in enhancing organizational efficiency. As I mentioned earlier, performance evaluation, resource coordination, and shielding subsidiary profits from other stakeholders. The multinational may also have less desire to retain profits in a subsidiary for growth and development, compared to a multinational that is planning to expand its market. So there's the two different strategies that a multinational might have. Other points, transfer pricing may play a greater role in aiding profit repatriation, as I mentioned earlier. Within the constraints of organizational strategy and other influences, transfer pricing can act as a control and resource coordination mechanism. Transfer prices also need to be used with a complementary control mechanism. As I mentioned earlier, the use of dual prices may need to be used, especially if the transfer pricing is not in congruence with the performance evaluation objective of the subsidiary manager. What about the regulatory environment? With the increase in cross-border trade and investment, tax authorities may in many countries have developed comprehensive transfer pricing compliance rules to ensure fair returns for the activities. Okay, we know they want fair returns. So we need to have a transfer pricing policy that can help in shifting profits from a high tax country to tax havens to minimize corporate tax. And we mentioned tax haven. What is a tax haven? Usually it's a country that is 15% or lower income tax. Yes. The shifting of profits may draw attention of the host government due to a lower contribution in terms of corporate tax to the society. So multinationals face the trade-off between the importance of the host government relations and tax minimization. And I can tell you now that this is something that provincial government in Guangzhou is starting to pay more attention to than they have in the last 5 or 10 years. They're starting to pay more attention to how much profits subsidiaries in Guangzhou are booking. Normally, they were happy if they booked 3, 4, 5, 6% profits on the average trade through Hong Kong and now China export to the world. But now they're starting to ask questions about what is making up those profits. And they, in the past, turned a blind eye to this average booking rate, and they're actually starting to ask more questions about justifying these profits and these transfer prices to other subsidiaries in Hong Kong. Okay, so keep this in mind. What about competitive environment? Well, there's several environmental issues that confront subsidiaries with respect to setting of transfer prices. Differences in cost structure, inflation rate, and associated foreign exchange risk. And it may be important to mask the profitability of subsidiary so as to give the impression to other competitors that you're not making much money in a particular country or a particular region. Also, there may be a way of making the profitability higher in a subsidiary so that subsidiary can obtain a local bank loan by showing that it has a record of a reasonable margin business that fits the subsidiary's operations. Furthermore, in a competitive environment, what problems are involved in using standard costing in a rapidly changing technological environment? Okay, so that's a big question that we should be asking. When there are rapid changes, it's very hard to set a single transfer pricing policy, and you may have to change from time to time, especially if you're using discretionary transfer prices. And so that's just an extra administrative burden. You have to justify changes in prices from time to time, and you may have to do that in especially rapidly changing technological environment. How does an multinational enterprise set standard for costs? In different countries, there are different stages of technology development. Well, the cost base may be different, and the learning, hence cost, curve may be different. So it's just a matter of extra administration to justify the particular costs that support the transfer prices, and especially if those transfer prices are of tangible goods, and so you can readily get another market benchmark price to compare those goods against. More in the second session of how transfer prices are exactly determined. Transfer prices can be used to mask the corporate profits of a subsidiary in certain countries in order to keep competitors out. And number two, for multinationals that require financing for investment, as I mentioned earlier, in subsidiaries in a host company loan arrangement, it is necessary for the subsidiaries to report some profit in their financial statement by the shifting of income from one subsidiary to another or through a transfer pricing policy. So if the subsidiary is engaging in low margin operations, deliberately low margin, in order to shift profits out of that country, that's going to be very hard for that subsidiary to justify it being a viable operation when it's trying to get a loan from a local financial institution. Instead, you might deliberately have a higher transfer price. Yes, you may have to pay more profits, tax in that country, but the point of this is to actually have a record over 3 years to actually get a loan from a local bank. And so to justify that we have normal operations and these are the normal profits from the normal operations, so therefore you can trust the ability of the subsidiary to pay back the loan. So we can have a look at some of the tables that summarize the conditions influencing transfer pricing. And there are two basic conditions here. One is conditions in the subsidiary's country that may induce low transfer prices on the flows from the parent and high transfer prices on the flows to the parent. Here are conditions in the subsidiary's country that can induce high transfer prices on flows from the parent and low transfer prices on flows to the parent. So we want low transfer prices on flows from the parent or high transfer prices from the flows to the parent. In these conditions here, this is maybe where we want to have more profits in the subsidiary's country. When we've got high transfer prices from the on flows to the parent, for example, there are high ad valorem tariffs, so therefore you can actually get rebates on various tariffs. The corporate income tax rate is lower than in the parent's country, so you want to have more profits in that country of the subsidiary, and maybe there's significant competition. Okay, so significant competition, you don't want to hide the profits, you want to show you're making profits, and you want to show that you're profitable, and that may be good from a performance evaluation standpoint for the divisional manager that's operating in that country. And local loans based on financial appearance of the subsidiary are important. What about the other way around? When might you have from lower transfer prices on flows to the parent? And so this has happened very commonly for the last 10 years or more, flowing from subsidiaries in China into subsidiaries in Hong Kong. We've had low transfer prices. In other words, a minimal profit margin on a subsidiary in China. When there are local partners, when there are pressures from workers to obtain a greater share of company profit, that's happening in China, we know that. There's political pressure to nationalize or expropriate high profit foreign firms. So you don't want to show that there's high profits more than what is normal. You want to show that they're lower than normal. There are restrictions on the profit and dividend remittances. So you cannot get cash out of the country through a dividend. So therefore you would have low transfer prices. And so you're able to actually shift more cash out through the trade to the parent. What about other conditions? High transfer prices on flows to the parent. Again, that's the same scenario in the first part of the previous slide. When there is an export subsidy or tax credit on the value of exports, so you want to have a high transfer price. When there's a lower inflation rate than the parent's country, and when there are restrictions in the subsidiary's host country on the value of goods that can be imported. What about low transfer prices on flows to the parent? Again, there's China example. Again, this has been pretty common last 5 or 10 years. Political instability, not sure about that. Substantial tie-in sales agreements, yes, possible. The price of the final product is controlled by the government, but based on product cost. So we have the desire to mass profitability of the subsidiary operations to keep out competition. Import duties, the effect of imported inputs, and there's profit and cost centers. Okay. Now remember, import duty, that will be paid by the parent. So we want to have a low transfer price. We've got to flow to the parent, so the parent doesn't have to pay as higher import duty. So what we've done today is actually just focus at the basic transfer pricing strategy, and I've actually introduced these other factors that complicate the perfect transfer price. Because if we didn't have to worry about government, if we didn't have to worry about the location of the subsidiary, if we're just interested in motivating the subsidiary manager, then the transfer price will be close to a market rate. The transfer price will be close to a negotiated transfer price. It will be in the control of the divisional manager and with their perfect information compared to the head office. But the problem is that things are more complicated. Subsidiaries are located in countries that may be there for particular value chain purposes. They may be there for particular competition purposes. They may be there for particular tax and regulatory purposes. And all of these purposes can conspire to make a transfer price that really doesn't fit with the whole original idea of a transfer price. That is, to just set up a price for the exchange of goods between two related parties. That is, to set up a price that is the exchange of goods in a decentralized environment where one manager, a human, has lots of autonomy and more information in most cases than the head office. And the transfer price is the only way to actually motivate that manager to act in the interests of the head office. And that was the basic starting point. And so I hope you get some better picture of the whole landscape of transfer pricing. In the next section, part 2, we're going to look at more specific government legislation, but with it as it pertains to the scope by which are allowed to set transfer prices. In other words, you can't set them too high, you can't set them too low. So then how do you set them? And basically how you need to justify the transfer prices that you do set. And so this also includes advanced pricing arrangements. So let's get into that good stuff in the next session. But for now, go back and review some of these factors that impact on transfer pricing and catch you in the class. Thank you for listening, and bye for now.